Did you know that the rich use debt to get richer and avoid taxes? It's a common misconception that all debt is bad. However, the savvy wealthy individuals use it as a strategic tool to expand their wealth and minimize their tax obligations. It's an art of financial wizardry that can be learned and mastered. Intriguing, isn't it? Stay with us to uncover this financial strategy. One of the most popular strategies actively used by the rich is called buy, borrow, die. It's a three-step dance to wealth expansion and tax evasion that the affluent have been twirling to for years. Step 1. Buy. The wealthy invest their money into assets that appreciate over time. These could be stocks, real estate, or even fine art. The key is to choose assets that not only grow in value, but also generate income. This income is often taxed at a lower rate than regular income, or not taxed at all if the asset isn't sold. Now let's move to step 2, borrow. Instead of selling their assets to finance their lifestyles, the wealthy borrow against them. They take out loans using their assets as collateral. This way they get the money they need without triggering a taxable event. The interest on these loans is often less than the income the assets generate, which means they're effectively making money from their debt. Finally, the ominous-sounding step 3, die. When the wealthy pass away, their assets are often passed to their heirs at their current market value, with no capital gains tax due. This is called a step-up in basis. The loans against these assets are paid off, and the heirs are left with valuable assets that can continue to grow tax-free. The cycle then begins again with the next generation. There you have it. The buy, borrow, die strategy in a nutshell. It's a fascinating, albeit controversial method that the rich use to keep their wealth growing and their taxes low. Some argue it's an exploitation of loopholes in the tax system, while others see it as smart financial planning. Either way, it's a strategy that's been used successfully for generations. This strategy effectively maximizes their wealth while minimizing their tax liabilities. You're unlikely to wonder how you can use this strategy if you don't have millions of dollars yet, and are just starting out on your financial journey. First, you need to understand the difference between good and bad debt. While the term debt often has a negative connotation, conjuring up images of financial stress and endless bills, it is worth noting that not all debt is equal. There is a significant difference between good and bad debt. Let's imagine debt as a tool. Just like a hammer, when used correctly, it can help build something substantial. But if misused, it can cause significant damage. Bad debt is like using a hammer to smash a window. It's destructive and leaves you with a mess to clean up. It's the kind of debt that arises from buying things that quickly lose their value and do not generate long-term income. Think credit card debts from unnecessary shopping sprees or high-interest payday loans. On the other hand, good debt is like using that hammer to build a house. It's constructive and can lead to something beneficial. Good debt is an investment that will generate long-term income or increase in value. For instance, a student loan is considered good debt. Why? Because it's an investment in your future earning power. Once you graduate and land that high-paying job, you'll recoup your investment and then some. Similarly, a mortgage can be good debt. Real estate typically increases in value over time, and the interest you pay on the loan is often tax-deductible. So, while you're paying off your debt, you're also building equity, a valuable financial asset. Even business loans can be good debt, if they lead to business expansion and increased profits in the long term. They provide the necessary capital to invest in equipment, inventory, or other resources that can drive business growth. So, the key to good debt is that it's a calculated risk, a strategic move. It's about borrowing money now to make more money in the future. Understanding the concept of good debt is crucial to financial success. It's not about avoiding debt altogether, but rather knowing how to leverage it effectively. So, good debt can potentially set the stage for greater financial success. Take Robert Kiyosaki, the author of Rich Dad, Poor Dad, for example. A world-renowned financial educator and investor, Kiyosaki is no stranger to the power of leveraging debt. He believes in using other people's money to create wealth. For instance, he has often leveraged bank loans to invest in real estate properties. These properties then generate rental income, which not only pays off the debt, but also provides him with a steady cash flow. What's more, the interest from these loans is tax-deductible, effectively reducing his taxable income. Now let's talk about Donald Trump. The real estate mogul and former president is no stranger to debt. In fact, he's been quoted as saying, "I am the king of debt, I love debt." So how exactly does he use debt to his advantage? Just like Kiyosaki, Trump leverages debt to invest in real estate. He borrows money to finance large-scale developments, and the income generated from these investments often outweighs the interest on the debt. Furthermore, the depreciation on his real estate investments serves as a significant tax write-off, reducing his overall tax liability. In essence, both Kiyosaki and Trump use debt not as a burden, but as a tool. They borrow money to invest in assets that produce income and appreciate over time. This approach allows them to grow their wealth and simultaneously benefit from tax deductions. It's a strategy that requires financial discipline and risk management, but when executed correctly, it can lead to substantial wealth accumulation. But remember, while this strategy has worked for Kiyosaki and Trump, it's not a one-size-fits-all approach. It requires a thorough understanding of financial principles and a careful assessment of risk and reward. It's crucial to seek professional advice before diving into any investment strategy involving debt. As you can see, these financial gurus have effectively used debt as a tool for wealth accumulation. So, real estate can be a great avenue to leverage debt for wealth accumulation. Harnessing the power of debt in this way can turn what seems like a burden into a tool for building wealth. It's not about having debt. It's about how you use it. Now, let's look at how the rich use debt to make even more money in the stock market and forex. This is where a margin loan comes into play, a type of debt that allows you to borrow money to invest in securities. This loan is secured by the securities you already own, and you can borrow against the value of those securities to buy additional investments. In essence, you're leveraging your existing assets to amplify your potential returns. Take the stock market, for instance. If you have $50,000 worth of shares in a company, and you believe strongly in its growth potential, you could take out a margin loan against these shares to buy more. If the stock price rises, your profits are magnified because you control more shares. However, if the stock price falls, your losses could be just as magnified, leading to a potential margin call, where you would need to deposit more funds or sell off securities to meet the margin requirements. Now let's talk about forex, the foreign exchange market. Here, margin trading is a common practice due to the high leverage it offers. In forex, you're essentially borrowing to invest in currency pairs. The ratio of the amount you borrow on margin to the amount you deposit is the leverage. Forex brokers often offer high leverage ratios, up to 200 to 1 in some cases. This means that with a deposit of just $1,000, you could control a trade of up to $200,000. The potential for high profits is enticing, but remember, forex trading can be risky. The high leverage that boosts profits when trades go your way can also magnify losses when they don't. That is why it is important to note that margin trading is not suitable for everyone in both the stock market and forex. It requires a good understanding of investment strategies and a high risk tolerance. The potential rewards are high, but so are the risks. If you're not careful, margin trading can quickly lead to significant losses. But with the right approach, margin loans can be a powerful tool in your wealth-building arsenal. They can help you take advantage of investment opportunities you might not otherwise be able to afford, amplifying your potential returns. Just remember, as with any investment strategy, it's vital to do your homework and understand the risks before diving in. Remember, while this strategy can be lucrative, it also comes with its own set of risks. So, use this strategy wisely, and it can be a key player in your journey towards financial freedom. Now you might wonder, how does debt reduce taxable income? Let's break this down. When we talk about debt in this context, we're not talking about the credit card bill you racked up buying the latest tech gadgets. No, we're discussing strategic investment-related debt. This type of debt is often used by savvy investors as a financial tool to grow wealth and reduce their taxable income. The trick lies in understanding that interest on such debt can be tax-deductible. Let's say you take out a loan to invest in a rental property. The interest you pay on that loan is typically deductible from your taxable income. This is because the loan is considered an expense incurred in the process of generating income. Therefore, the more interest you pay, the more you can deduct from your taxable income. This is where the concept of leveraging comes into play. Leveraging is essentially using borrowed capital to increase the potential return of an investment. If an investor can borrow money at a lower interest rate and invest it in an asset that provides a higher return, they're making a profit. And remember, the interest paid on that borrowed money is tax deductible. However, it's important to approach this strategy with caution. The benefit of reduced taxable income should never be the sole reason for taking on debt. The primary objective should always be to make profitable investments. The tax savings are just a bonus, a smart way to maximize your profits. Now let's put this into perspective with an example. Imagine you borrow $100,000 at an interest rate of 5% to invest in a rental property that generates a return of 8%. You're making a 3% profit. And the 5% interest you're paying? That's deductible from your taxable income. In essence, strategic investment-related debt can provide a double benefit. It can help you make more money from your investments and simultaneously reduce your taxable income by allowing you to deduct the interest paid on the debt. So, debt can actually serve as a tax shield. It's a powerful tool in the world of finance, but like any tool, it must be used wisely and responsibly. As we've explored, the rich use debt strategically to get richer and avoid taxes. Everyone can use debt to get richer, but do it smartly. Remember, the right knowledge is your best investment.